Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Paul Sweeney, along with Tom Keene. Join us each day for insight from the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Jennifer Ryan sitting in for Tom Keene. He is on holiday this week. We know not where. I'm sure someplace exotic. I'm here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast here. A lot happening on the economic calendar, a lot happening on the central bank calendar this week. All eyes are going to be on the Fed there. We're going to hear from Fed Chairman Jay Powell on Wednesday. We'll send Michael McKee down there on the Acela train, and he'll have all the reporting for us on Wednesday. Let's check in with Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Lori, is it all about the Fed here? I mean, do earnings matter? Are we just kind of waiting on the Fed to see if it's 2 cuts, 3 cuts, maybe a hike in there somewhere? I don't know. How are you guys approaching the overview of this market?
It's a great question, and thanks as always for having me, by the way. But, I joke that as an equity strategist, we've all sort of had to become rate strategists these last few years. And thankfully, I get along with my rate strategist very well. He does a great job. But look, I do think that to some extent, I wouldn't say maybe all about the Fed, but I would say maybe mostly about the Fed. So maybe, like 80, 90% or so. And, I would say in my conversations the last few weeks, at least I feel like we've got a lot of the angst out of the way. So it's been the economy is hot. How can the Fed possibly cut? Oh my gosh, there aren't going to be any March cuts. And we've been kind of pushing back saying, well, we never thought there were going to be March cuts to begin with. We've always been looking at June. Our guys have dialed down their expectations for cuts in the back half of the year. So we have, pivoted a little bit, but probably not as much as other folks. So I would say, we're watching, as always, the commentary this week. As an equity person, I care what Powell says on inflation, the labor market, and kind of the overall characterization of the economy. But, it always does kind of come down to the dots. So we'll see what happens.
So how are you recommending people play this? Do you like large caps or small caps? Are you big on tech, souring on tech a bit? Tell us a little bit about what your picks are.
Yes. So, we are kind of, we don't make a ton of sector changes all that frequently. Our last batch was back in January. That is very characteristic of us to kind of move slowly and not that often on the sector views, but we did downgrade tech. And part of what we thought was just that tech, if you looked at the median stock valuation, 6 months, kind of middle of 2023, still looked pretty reasonably valued. And by the time we got to the beginning of 2024, your median tech stock was pretty darn expensive. So it wasn't just, sort of the big mega cap growth names that we had sticker shock on valuation for. We've also thought, that frankly, we were never sort of headed toward an imminent recession the way a lot of folks were. So we've been in the rotation camp, and we said at the beginning of this year, it's probably going to take a while for the rotation to happen. The thing that really needed to happen was that economic expectations needed to get reinvigorated. That's the why of this whole, Fed kerfuffle right now, right? If the Fed holds off on cutting or minimizes the cuts, it's because the economy is great. It's kind of twisted a lot of people's heads into a pretzel, but we've really been trying to position our sector views for that move kind of into cyclicality down the road.
Hey, Lori, I know as head of strategy, a big part of your role is to travel really around the world and meeting with RBC's big institutional investor clients. As you've been doing that this year, what's the sentiment been out there, and how has it changed maybe?
It's a great question. Our sentiment indicators tell you there's a lot of froth out there, specifically if you look at CFTC, where we've been around, early 2020 pre-COVID highs, early 2018 highs. I would say things don't quite feel that frothy in the conversations. They feel more like the AAII indicator, which is about 1 standard deviation above the long-term average. So it's at a problem point, but not at 2 standard deviations, which is when things have typically felt very, kind of silly over the course of time. So things don't feel silly. It feels like a begrudging bullishness, like people have sort of been pulled into this fighting tooth and nail, and they've sort of accepted, that the economy is on a decent track, but they're not all that happy about it. And they're frustrated by the dominance of the big names, but they're, sort of confused about when that leadership is actually going to shift. So I would say it's kind of frustrated bulls out there would be my characterization.
Frustrated bulls. Another question on what you're getting asked is anyone starting to ask you questions about how to position for the U.S. election?
Good.
Yeah, it's a great question. It depends on where they live, is the honest answer. So European investors, Canadian investors, obviously I work at a Canadian bank, so I spend a lot of time with the Canadian investors. We have a franchise down in Australia as well, so I spend a decent amount of time talking to those folks. That has been, kind of one of the top questions in my meetings since last summer, and really heated up in the fall, in December and January as well. In the U.S., it's really the interest has been sparked by the primaries and caucuses. And it's, we've used this phrase in the past, staring at the sun. End of last year, people were like, I'll look, but let's talk about it really quick and then let's look away. It's too painful. There's nothing to do yet. Now they're opening their eyes, letting their gaze, sort of stay there a little bit longer. It's still pretty painful, though, so people are happy to get out of the conversation. I don't think people are doing a lot yet, but they're dusting off the historical playbook. One stat we like the financial sector, and everyone likes the stat that 7 of the last 8 presidential election years, you've seen the financial sector outperform the S&P, the only time it didn't in the GFC. So that's sort of a good, data point for people. I joke and say there's safety in numbers, right? It's such a difficult topic to talk about if you live in the U.S. But I say, professionally, there's safety in numbers. So let's just talk about the numbers and what those represent.
All right. How about you just mentioned the financials there. Why do you guys like the financials here, given we may see the Fed start to cut rates this year?
So look, I think if the Fed cuts a little bit, the economic backdrop stays, decently strong, and inflation is somewhat contained, still heading in the right direction. That feels kind of like the sweet spot for the banks to me. I think if we really do view the financials as the plumbing of the economy, it's kind of become a boring sector. That wasn't, the case back in the, kind of 2000s, pre-2010. Back in, prior life cycles, but it is kind of a boring sector at this point in time. And if you think the economy is on the mend, it tends to do very well when consumer confidence is recovering. And that does seem to be the case since 2022. We're in this slow, kind of staggered, halting uptrend. But also it's just cheap. I will tell you, Gerard Cassidy and our banks team, John Armstrong covers the regional banks. They have generally been more constructive than our analysts in other sectors. And Gerard in particular has really kept a cool head through a lot of the episodes that have happened over the last year and a half. And then frankly, if you look at banks' earnings revisions, they're midway through an earnings revision recovery. So we like that component. And then if you just go back to the rotation trade, you have to think about it in market cap terms. If we take a lot of the money out of big tech, or even a decent amount, and roll it into other parts of the market, I really think that the financials ultimately have to participate. If value outperforms, financials tend to as well. And that's really just a function of their big market cap in that part of the market.
Can you shift gears a little bit and talk to us about what your views are on energy? That's been doing enormously well so far this year. But we've got a potential for a slowing economy, potential for lower rates. What's the best way to think about energy going forward?
So I would say on the economy, if you look at the data, and we pull this off Bloomberg just on the ECFC function, so I'll give you guys a little bit of a plug, but if you monitor how GDP forecasts are moving, back last summer, 2024 real GDP on the year was expected to be 0.6%, so just barely in positive territory. The beginning of this year, it had moved to above 1. I forget exactly where it was. As recently as mid-February, it was 1.6. And at the end of February, it hit 2.1%. And that's still where I believe it is today. Yep. And so we've really been seeing the economic story improve. Multiple quarters for 2024 are now seeing improvement. So I don't buy the idea that we're heading into a stagnant, economic backdrop. I think that we're breaking out of the malaise that's characterized the last few years, where people have said it's going to be sluggish forever. It's like, oh, no. So that benefits energy. But frankly, it's also an inflation hedge, and it's cheap. Yep. And then you've got geopolitical risk. So we like a lot about it right now.
All right, Lori, thank you so much, as always, for joining us. Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Let's check in with David Katz, President and Chief Investment Officer of Matrix Asset Advisors. Hey, David, thanks so much for joining us here. I mean, we got a busy week here. A lot of central banks reporting, with some of their comments and statements, and we're going to get some views from a lot of central banks here. When you step back and you think about our central bank, our Federal Reserve, what do you think we're going to see? And do you think the markets are accurately discounting what we might see?
I think the markets are coming to terms that the Fed is going to be less aggressive in lowering rates this year and probably starts a little bit later. We're not expecting any great news out of the Fed this week or any incrementally new news. We think they're going to talk about wanting to see better inflation numbers, but the idea that they will be lowering rates will happen. They're just not going to give a time frame. So we don't think anything new is going to come out of the Fed. We think if anything, it creates a little bit of a headwind for the market this week. But today, the market seems to be ignoring that.
But looking further ahead, I mean, we've got a whole bunch of other central bank decisions coming up this week. Do you feel like the vibe is going to be overall more hawkish than people are expecting, or is it going to be like some signs of dovishness coming through?
We think there is going to be a balance of both of those. We think the critical thing for investors is not to get obsessed with the exceptionally near term. Understand that the Fed and the other central banks are likely going to be more dovish as the year progresses. And if you're investing today, the markets are going to discount that sooner rather than later. So we'd be looking to put your portfolio to work with the idea that the Fed is going to be lowering the rates. We're generally optimistic about stocks this year. We do expect a lot more volatility than we've seen. You had a great fourth quarter and a very good first quarter. So there's going to be some volatility. There's going to be some pullbacks. But we think ultimately stocks end the year higher than they are now, probably in the low double digits.
All right, David, given that background, what are some of the sectors you like here, assuming, I haven't been long the Magnificent Seven like Tom Keene has? What do you like sector-wise?
So basically, we think there's going to be a rotation this year with some of the things that did not do as well last year starting to do better. We think that the things that did great last year are going to slow down. You're already starting to see technology slow down some. We think that's going to continue. So we wouldn't chase last year's winners. Healthcare and financials started this year off very good after a very poor 2023. We think that's going to continue. So we think there are lots of opportunities in that area to make money on a go-forward basis. Utilities had a very poor 2023 and even a worse start to 2024. So we think that if you have a 6 to 12 month time horizon, there are lots of stocks in the utility sector that we think are going to be good investments, especially if the economy slows down a little bit later in the year and the Fed starts to lower rates. We think utilities are going to be a very good place to be. So nice place to make money with much lower risk.
Looking at the returns so far year to date in different sectors of the S&P 500, the one at the very bottom is real estate. What's your view there?
So we don't have a great conviction on real estate. We think that if rates start to go lower as we expect, it probably gives them a little bit of a tailwind. But there's so many moving parts right now with real estate. We just think they're better places to make money. So that's a sector we don't have a great conviction on. We've been negative on it for the last 18 months. I'd say we're probably neutral at this point.
David, one of the names on your list that jumps out at me is one we all know, Cisco. CSCO is the ticker symbol there. $200 billion market cap, but the stock's just kind of flat here year to date, flat over the trailing 12 months. It is certainly not, received any AI pop. What's your call on Cisco?
Well, we do think it is a second derivative AI play as more communications take place, as computers and PCs are using more mainframes in the cloud to do AI. We think Cisco is going to have to lay out more cables. You had a problem last year because there was a lot of over ordering because people weren't able to get as much as they wanted. When Cisco was able to fulfill all of their orders, a lot of those orders got canceled. So that's made a 2 or 3 quarter slowdown in their revenues. We think it's going to pick up this year. We think the worst is behind them. Stock's at 12, 13 times earnings and pays at like a 3.5% yield. So we think for investors that have a 12 to 18 month time horizon, they're going to start to catch up. We're not expecting anything spectacular, but we easily think the stock has 15 to 20% upside with very low risk.
Another name on your list, which intrigues me quite a lot, Starbucks. The stock's not been doing particularly well over the last 12 months, but what's the play there?
Double short.
So the great thing about Starbucks is they make an addictive product that generally is pretty safe for people, and in fact, in some cases, healthy for people. They've got a great footprint around the globe. The stock has done poorly in the last 6 months out of concerns that China is slowing down. China is slowing down, but China is going to start some stimulative packages in the next 3 to 6 months, and you're getting Starbucks at a great price. It pays a good yield. We like the new CEO of the company. We think the company is very well positioned for the future. Gen Z likes their products. They like the iced and coffees. So we think that they are going to be a force to be reckoned with for the long term, and you're getting it at a very good price.
David, here's a name. We had the regional banking crisis starting, a little bit more than a year ago. And I've always said, boy, I'd love to be able to kind of go into my PM if I'm at a hedge fund and say, hey, give me another couple $100 million. I'm going long regional banks. I think this is the bottom. I'm not sure we're there yet, but PNC Bank is on your list. And it's not really a regional, it's kind of like a super regional, I guess, but it's, I think, kind of grouped with some of those regional banks. Is it safe to go into some of these names, do you think?
It's safe to go into the best quality super regionals. So the banking group has had a stealth rally since May of last year. They've done really well after the pain of last March, April. But we really would want to focus on the best quality companies, best credit quality, good commercial real estate portfolios, and conservative financing. PNC meets that ticket. U.S. Bancorp, same thing. Bank of New York. We would not delve into the lower quality companies just because we don't know the risk there, and you only find out the risk or the big problems after the fact. Some of the ones that I mentioned, really good quality, very good valuations, very nice yields. We think if the Fed starts lowering rates and we don't have a recession, which we're not forecasting, these companies should do quite well.
Real quick, we don't have a lot of time left. Apple, we've been talking about it a lot this morning. What's your view there, especially with the news about the potential tie-up with Google?
So we own Apple. We went into this year when it was the 190 to 195 level, a little bit less enthusiastic. At the 170 level, we think it's a very good re-entry point for new monies. We think today's announcement or speculation is a positive. Apple is going to have AI on their new phones, whether it's with Google or with someone else. There will be a new product cycle. We think the market has gotten overly negative over the last few weeks, so it's a pretty good entry point. It's about fairly valued, but we think we'll go higher.
All right, David, thanks so much for joining us again. David Katz, he's the president and chief investment officer for Matrix Asset Advisors. Let's step back and take a big holistic look at these markets. And we can do that with our next guest, Dana Dioria. She is Co-CIO of Envstnet. Dana, thanks so much for joining us here. I'd love to just start with asset allocation here. We kind of grew up with a 60-40 equity fixed income portfolio. And now a lot of folks are saying, hey, you need to have a meaningful presence in alternative investments. So let's step back. In asset allocation, how do you guys think about it right here?
Well, we definitely at Envstnet, accommodate both, right? At a high level, I would say the balance, the 60-40 still dominates, no surprise there. And it's interesting because I'm sure you hear a lot of this, of course, because in the last few years, we've just had, several times where it didn't seem like equities and fixed income were hedging each other. The performance of fixed income, I think, is the real issue that people are having and why you're hearing kind of more of a push for alternatives. Everybody expects equities to drop. They're not as sanguine about seeing their fixed income losing, especially when it gets to double digits. But there's I would say, a steady increase in interest in alternatives. And I also think a lot of the big alternatives players are looking to come down market to, sort of the retail advisory area where I sit. So I do expect, just because there's interest there as well, to see more of that.
What do your clients say to you about equities? Because, we're looking at the futures this morning. There's a lot of green at the start of a week where there's a very strong expectation that the Fed could wind up being more hawkish than anything we would have expected at the start of the year.
Yeah, I think it's priced in at this point. I think we started the year with such a high expectation of rate cuts, and it really didn't make a lot of sense with where the data was, right? The Fed had said at the end of last year, higher for longer. Obviously, the Fed's mandate is inflation and employment, and both of those point very strongly at this point to not cutting. So I don't think anybody's expecting a rate cut this week, and I think that's been, kind of fully priced in. The question, of course, is what is Powell going to say? I would expect that, he does come out trying to thread the needle. But the reality is that if we don't see some cracks in employment, and we do see inflation remain sticky, obviously PPI, core inflation as well, have been stickier than what we've wanted. And, things like initial jobless claims. I mean, yes, the unemployment rate ticked up a bit, but initial jobless claims really are remaining strong. I think 2 is certainly on the table, all else equal today.
All right. So given kind of that background, which, I guess from an interest rate perspective is kind of uncertain, where are you suggesting in the equity markets investors maybe put their focus these days?
Well, we look at it, of course, from a long haul perspective, right? I mean, when you're thinking about just people's nest eggs and retirement planning and everything, and kind of the point I try to make is that if you're invested in the index or you're invested even in a typical active strategy, that's not going to want to take massive tracking error. We've seen a lot of active managers, kind of struggle, right? Obviously, with the cap weighted indexes being so heavily weighted in the Magnificent Seven, and they just, the blowout performance there. It's really hard from an active management perspective to take too much tracking error. And what that means is that most people have their portfolios invested pretty heavily there. So tilt to the extent that you can away from that, I still do think makes sense. And I think depending on what your time frame is and how you're looking at it, you can go about that differently. I'm a proponent of small and small value in particular.
Really?
And again, you're not putting the whole thing there, but a tilt there. It does outpace inflation over time. It has returned better than the market over the long haul. But what else we're seeing as well is a quality tilt. If you think we haven't, kind of on the other side of the spectrum, I'll say, right? If you think that we haven't gotten past recession concerns, you look at how quality is performing so far this year. And of course, you've got Nvidia in there and Meta, in the standard index there. So of course, that's performing very well. But a defensive position, whether it's fundamental kind of defensive position or volatility-based defensive position, I think can make sense if you're worried about you want to stay in equity markets, but you're kind of looking at how things are developing and concerned that maybe the soft landing is not a guarantee.
Talk to me a little bit about what your expectations are for corporate earnings for the rest of the year.
Yeah, I mean, the question is, I guess, around, have we, again, I'll use the word, have we become too sanguine about, the fact that corporate teams now are going to be rolling over debt in a higher for longer type of environment. Obviously, the Magnificent Seven, this is another place where they've really, shined because the expectation is very high already. The multiples there are very high. The earnings appear so far to support it. And then you kind of look at, so I segment it and say, okay, and then I kind of look, across the spectrum at smaller caps and my, my aim there would be a longer haul kind of a investment, because it is very possible that when you get to that side of things and you look at companies that can't necessarily self-fund, they do have to go to capital markets, and they are facing interest rates that maybe aren't going to decrease as fast as they thought. Small caps tend to be more interest rate sensitive. So if you kind of split up, the corporate universe and large and or self-funding, I'll call it, right, which tends to be more large, not obviously entirely, and then, versus the part of the market that really does need to go to capital markets, I think that's going to have, that will play out differently. Now, of course, again, if you're in a standard index or if you're in an actively managed solution that, has not huge tracking error, you could probably live through, what comes out with corporate earnings, even if productivity doesn't necessarily kind of heal all wounds, and live through it, buy at maybe lower valuations for some of these companies that have to kind of get to the other side, and then when interest rates are decreasing, they do benefit.
All right, Dana, thanks so much for joining us. Really appreciate getting your thoughts as always. Dana Dioria, Co-CIO of Envstnet. All right, your daily look at the front pages around the world. All right, Lisa, lots of stuff we could go here with the newspapers. Where do you want to start?
All right, we're starting with Bloomberg. Mark Gurman had the great article out about Apple CarPlay, where you can listen to the Bloomberg Business app, yes. So CarPlay, it was originally designed to fend off Android, right? So Bloomberg is reporting since Apple nixed those plans for its own car, that the CarPlay is like a bigger thing right now. So this new concept for CarPlay, how is it different? It's going to be fully integrated into the vehicles, so it would take over more screens as well as more features like the radio and air conditioning. Now, Paul, you have the CarPlay. So the current one interface, they say it's more focused on Apple services, doesn't handle most of the car's controls. So that's why this one's going to be a little bit different.
Ah, okay.
So it's supposed to be better better this way. It responds to Google's Android Automotive, where the competition is, because that one is installed to the car itself. So you see.
Well, what I find, I just got, Jennifer, a new car, so it comes with a big screen.
Okay.
Which is all new for me because my car before it was 10 years old didn't have any of that kind of stuff here. So what I found is this screen is actually kind of your iPhone up on the screen. So it's got everything you use on your phone, like the Bloomberg Business app or like Google Maps, for example. And boom, it's just kind of up there. It's all integrated. And I think that's, so for better or worse, Apple's more integrated into your driving experience.
So that's what they want to, exactly. That's what they want to do. Because
right.
before you couldn't do some of the car controls with it, so now that they want to change that.
Very
Make it
good.
more competitive. You gotta. It's a competitive market out there.
Well, I kind of say that, the Consumer Electronics Show out in Vegas in January every year is basically now just an auto show with some, toys around it. So
you see where it's going.
Yeah, fully integrated. What else you got?
All right, this is the Wall Street Journal. The hottest ticket in American dining, they say, is Applebee's Weekly Pass. People went crazy for this. You paid $200. Basically, it's a date night pass. It's a subscription. And it sold out in less than a minute. Here's why. Because people are trying to save money, right? So with this pass, you get $30 off of each bill once a week for a year. So people only paid $200 for this. It sold out quickly. I mean, prices to eat, you've been out to eat, right? It's crazy.
In this city, we don't eat out anymore, basically, which is like, why are we living here?
Yeah.
But hang on a second. Is this going to be a good thing for Applebee's? Because I feel like there's a lot of people who are saving a lot of $30 here and there. That's going to add up.
They did. They sold like a limited number.
Okay. Okay.
But the thing is, it's like they talked to one couple on it, which was interesting because they won it. They said it's like winning the Applebee's, lottery. And they went out, and when they travel, they go to Applebee's now. So they save on their vacations wherever they go. They kind of do the Applebee's.
And the largest Applebee's is in?
Where?
Times Square.
Oh, is it? Okay.
Yes, that was part of the story, so I saw that. Yeah,
See?
it makes
Yep,
sense.
there you go.
But I mean,
that's like the biggest.
I think food inflation, at least for me, at the supermarket, and then we go out a lot because we're empty nesters, is it real?
Yeah.
I mean, and you can just see it. So I think a lot of consumers, like what we've done is traded down from name brands in the store to the store brand.
Yes.
For a lot of things.
Yeah. But we have a friend visiting in town from London now, and his eyes are popping out of his head at the prices. And that's a guy coming from London.
Exactly.
It's bad when that happens. And you had your $89 steak, I heard, and you saw the restaurant
Utah, now
prices.
it was a great steak, but it was at 9,000 feet, so it took a while to get that cow up there. But I guess that's worth the 89. But man, that was ridiculous.
Oh,
crazy.
What's also ridiculous are home prices, because that is a link to our next story. Business Insider has this. It's a community of tiny home villages, and they are selling out fast. It's South Park Cottages just outside of Atlanta. So the whole thought behind it was to create this community where everybody could afford a home, right? Because they start at $190,000. They're small, the 1 and 2 bedroom units ranging from like 400 to 650 square feet. But the mortgage payment around $1,500. So it's equal to what they were paying in rent, but they get to own something. So that's the difference. And it worked. All 29 units sold out in less than 2 months. They haven't even, over a year before they were even started building it. So that developer now going to build another community in Georgia, kind of with the same concept behind it.
They should bring that to New York.
Yeah. I'm looking for an apartment right now. Like, can we please bring some of these to Astoria?
Exactly.
But it's crazy. Yeah.
I mean, I think in the city, the panacea would be here in New York, and I guess a lot of other big cities, is take these vacant office buildings, convert them into residential. It sounds easy, but what I've been told by the real estate pros is it's a lot harder than that. And in some cases, it's impossible structurally wise and so on and so forth. And in other cases, it's just prohibitively expensive to make the changes that would be needed. But
Yeah, Bloomberg has actually done some incredible stories on this. And like one of the things that you don't think of is, for example, all the windows are at the edge. So if you've got a place in the middle, you've got no direct sunlight.
No light.
Yeah, so I don't know what's going to happen there. But all right, maybe we'll just buy these little micro places. All right, what's next? And this next one, I'm not sure I want to go to, but let it rip.
It's about your toes and your feet,
Oh, boy.
okay? Feet health. Forget the six-pack abs. You need well-spaced toes. This is the latest new fitness trend. Apparently, healthy feet, they help with balance, stability, right? They help build foot strength. So that's where this comes. Better spread, better balance. You get it? Okay, so toe spreaders. They are becoming popular. You get them when you get a pedicure. You know, they put the little toe spreaders in your feet. Now it's a must-have training tool. So people are buying these. You have models showing them off. You have these elite athletes showing them off. They cost about, $10 you can pay for one, or you can go as high as like $65.
And this is kind of like this Kim Kardashian brand Skims. They've got the waist trainer.
Oh,
now
okay.
This is the toe trainer.
The toe trainer. Yeah, but it's like the hot new thing. They're made from like felt foam, silicone gel, you name it, but it's about your foot health. So you got to watch your feet, Paul. Make sure they're spread nicely. Okay. Your toes.
Well, I'm not the one squeezing my foot into these crazy high heels like you guys are. So, I mean, don't look over here.
That's the issue. It's the women who has these tiny little shoes and you're walking around everywhere and your toes get all cramped up. But yeah.
All right, Lisa, that was the newspaper segment with Lisa Mateo. Thank you so much, Lisa. We appreciate that. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, geopolitics, finance, and investment. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show. Weekday mornings from 7 to 10 Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And as always, on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.